The spread is the difference between the sell, also known as the bid, and the buy price, also known as the ask. For example, there might be a 2-point spread. The bid price refers to the highest price that a buyer will pay for an asset. For example, if you currently hold an asset and you want to sell it quickly, you will sell at the bid price to a buyer who is waiting to buy the asset at a lower rate than the ask price. Ask. The ask price refers to the lowest price that a seller will accept for an asset. For example, if you want to buy an asset quickly, you will buy at the ask price from a seller who is waiting to sell on the ask price at a higher rate than the bid price. Market makers. A market maker is an institutional bank, firm, or individual that are both buyers and sellers of an asset. They will both post a sell and a buy, which creates the spread and provides liquidity, also known as movement, to the market. Market makers profit from the difference in the sell to buy price or the bid to the ask price. Slippage. Slippage can sometimes occur in fast-moving markets or from a larger spread. It is the difference between the price that you thought a trade was executed at, a buy order or a sell order, and the price that the trade was actually executed at. It's basically the time delay of the trading transaction. Stop order. Stop orders are orders that are triggered when an asset moves past a specific price point. Once past a specific price point, stop orders are converted into market orders, where they are then executed at the best available price. There are different types of stop orders, such as buy stop orders and sell stop orders, but stop orders are mostly used to limit losses with a stop loss. Spread betting. Spread betting allows investors or traders to speculate on the price movement of an asset, such as stocks, Forex, and commodities. With spread betting, no asset is actually being purchased or sold. Market trend. The market trend refers to the general direction of a market or an asset over a given period of time. Different market trends include an uptrend, a downtrend, or a ranging market. Candlestick charts. Candlestick charts are a visual representation of the movement of the price of an asset over a period of time. Most day traders will use candlestick charts to carry out technical analysis in order to help them establish a basis for taking a trade. A candlestick provides 4 pieces of information: the open price, the close price, the high that the price was at in the period of time, and the low that the price was at in the period of time. Profit-loss ratio. A profit-loss ratio is used to manage risk when trading. It is a ratio that determines the expected profit against the expected loss of a trade. For example, a 2-to-1 profit-loss ratio means that in a trade, the profit target will be 2 times the stop-loss order. A positive profit-loss ratio can be utilized when trading to try to maximize profits by aiming for higher profits whilst keeping losing trades lower. Indicators. Indicators can be incorporated into technical analysis, and there are many different indicators available to use. They help us to interpret the price action of an asset. However, indicators are always based on previous price action, therefore they lag slightly behind current price action. Different indicators include moving averages, relative strength index, and Bollinger Bands. Moving averages are a common indicator that can be used in technical analysis. Moving averages tell us the average price of an asset over a period of time. There are different types of moving averages available which highlight certain pieces of data. For example, an exponential moving average, also known as an EMA, will take recent price action into account more strongly than older price action. Support level. A support level refers to a price level where an asset has previously received a strong demand which has prevented price from declining past this level. Resistance level. A resistance level refers to a price level where an asset has previously received a strong selling demand, if you're in an uptrend, which has prevented price from exceeding past this level. For example, in an uptrend, a resistance level can create a ceiling of resistance above price and may prevent a further continuation of the uptrend. Thanks for watching this video.